Welcome to another Pendal podcast. Today, I'm joined by Julia Forrest, Portfolio Manager in Pendal's Australian Equities team. Julia, it's been a tough year for REITs, A-REITs. What have been the main challenges facing the sector and impacting returns?
It has been a tough year. It started late last year. We had a couple of CPI readings which were higher than expected, one in September and one in October, which led the market to reconsider where interest rates were going. We just had 3 rate cuts and the outlook for interest rates had changed quite materially. And then leading into the year, obviously we had the conflict in Iran, which lifted oil prices and lifted the outlook for bond rates, which didn't help either. So the REIT sector by the end of March this year was actually down 20%. So bonds had lifted from 4.1% to 5.1%, so they put on 100 basis points. And we'd seen 3 consecutive interest rate increases in the cash rate. So REITs were looking like extremely compelling value. We thought they were reasonable value at the beginning of the year, but they were even cheaper by the end of March. And the REITs that were impacted really were the rate-sensitive ones, like the fund managers, Charter Hall, Centuria Group, and then also the residential REITs, which residential is very sensitive to rate changes. So the likes of Stockland and Mirvac and Ingenia really underperformed for the first quarter of this year. So the REIT sector had a tough time. Obviously, the rate changes impacts the cost of funding as well. Yeah, so the sector really struggled in the first quarter of this year.
Okay, so fast forward to the end of the June quarter and we're now into July. Are things looking better?
So over the last couple of months, in response to the 3 consecutive rate hikes, we've seen data slow. We've also seen the conflict in the Middle East recede, which has seen oil prices fall, and we've seen bond rates fall as well. The sector got to the point where it was so cheap, it was on 13 times. This is around May this year. And it was absolutely compelling value, especially relative to the broader market. And then we saw a number of transactions, physical transactions, so in terms of commercial real estate deals transact, either at book value or above book value. We also saw a couple of REITs upgrading their earnings. So even though the sector was looking quite depressed, the earnings outlook continued to be quite robust. So Charter Hall had their 3rd earnings upgrade for the year. So earnings were up 26%. And Vicinity upgraded their guidance too. So the outlook certainly changed. The data in terms of economic data started to slow, and that changed the outlook for the path of interest rates. So the market is still expecting 1 interest rate hike by the end of this year, although that expectation has been receding with the latest data. So the outlook definitely improved for REITs. Bond rates came back, the outlook for interest rates changed, and earnings have been very resilient.
Yeah, just dig into the earnings part of that. Why have they been so resilient? Why were there upgrades?
So Charter Hall Group, their funds under management increased. They've seen big inflows into their funds. Investors, wholesale investors, sovereign wealth funds wanting to invest in Australia. Australia screens extremely well from a global perspective. And for Vicinity, the outlook for leasing spreads and for occupancy levels in the big shopping centre continues to be very strong.
Okay, so how's the portfolio being positioned, you and the team, to take advantage of these opportunities?
So we have been overweight Vicinity. We had been overweight the mall REITs for most of the year. Also overweight the resilient retail sector, so things like Charter Hall Retail, which is the small suburban centres that trade. They have supermarkets and they have a number of specialties that trade off them. Waypoint REIT, which owns petrol stations, which performed extremely well. We're also overweight affordable residential real estate. So we like Aspen, which is affordable residential real estate, mostly in Western Australia, with some in South Australia. We like Gem Life, which is a land lease community business, has very strong tailwinds with the ageing population, downsizing. We also like Stockland. Stockland hasn't performed that well, but it does offer affordable residential by cutting their land sizes smaller and smaller to make them affordable. The other stock that we're overweight is Goodman Group. which is taking advantage of the data center demand, and they have a big data center development pipeline.
Julia, you live this, and I've spoken to you for a number of years, and you know A-REITs, no doubt about it. What do you think investors are missing about the potential of A-REITs, though? So sort of remove yourself from what you do every day. What is it about the potential of A-REITs that people aren't getting at the moment?
I think what they miss is that construction costs are really, really high and have been rising this year. So we're not likely to see any new supply of stock, whether it's shopping centres, office buildings. We've got a couple completing this year that were commenced a few years ago, but the outlook for new stock for office buildings is very low. Because it doesn't stack up. If you look at construction costs, which are up around 45% in the last 5 years, it's uneconomic to build new office buildings, new shopping centres, and to some extent, some logistics as well. So there's no supply outlook, and demand continues to be resilient because population growth continues to be strong. So you've got no new supply, you've got the top line growing, so you've got the rental stream growing well. It's secured by long leases with fixed increases. So the total return story continues to be very strong.
So broadly, I mean, it's probably since COVID, where does right now rank for A-REITs? Because at the time I have spoken to you, there have been some pretty down times. There's no doubt about it. But right now, what's it look like?
We're expecting total returns in the range of 7 to 9%, which positions them quite well, given that you get the majority of those returns in your dividend yield. And on the earnings growth side, that earnings growth is mostly contracted by long leases and fixed increases. It carries a lower risk. So we think that A-REITs fit perfectly in a portfolio.
Thanks for talking to us today, Julia.
Pleasure. Thank you.
You've been listening to another podcast from Pendal. I'm Sean Aylmer.